Progress.
Good evening, ladies and gentlemen, and welcome to yet another webinar where we will be having a insightful session on smart guidance for active investing. And to talk about this today, we have with us a very special person, Mr. Gaurav Motwani, who will be addressing the session. He is the Chief Manager for Investment Awareness from NSE, and he has given his precious time to speak on the topic with us. Before we start with the session, I would definitely like to let you know what we are going to do today. So Mr. Motwani will be speaking, and after that, I'm sure you will have lots and lots of questions. So please note them down, don't forget them, because after the session, we will have a question and answer round. So without any further ado, ladies and gentlemen, while I can't see you, I would definitely want to know that you are welcoming Mr. Motwani with a huge round of applause. Welcome, Mr. Motwani.
Thank you. So we'll start today's session. I hope my screen is absolutely visible to you all. So welcome everyone once again. And today we are going to talk about some of the important aspects of an active investing. So, who is this module for? Who is it targeted towards? So anybody see, I introduced two characters over here. So they are Bhavesh and Bhavna from Bhavnagar, and Bhavesh is 35 years old and runs a departmental store, and the wife is a professor, and they have twins. So they've been investing in the stock markets for about a year or so, and this is mainly based on suggestions from friends and brokers, and sometimes even they made money, sometimes they lost money. And they want to learn more about the capital markets in depth. They want to get into active investing where they do their research themselves and start investing. That's what they want to do. And what is their target? So anybody who wants, a regular income for, their enriched life and planning for their children, higher education, saving for the future as well, and the retirement. So that's how this module is drafted. So as we know, there are two forms of investing. One is a passive form of investing and the other one is the active form of investing. So assume over here that a lot of people who are already investing in mutual funds and other ETFs, the passive form of investing is something which is easier to go about. And they want to venture into the more practical side where they want to be an active investor. So it's more targeted towards them. So what is the agenda that we will start with? So we first talk about primary markets. What are primary markets? We'll talk about some due diligence, what is required while investing in primary markets, and also about ASBA. Then we'll move into secondary markets. We talk about some trading and settlement, and also we'll cover about investor protection. We'll talk about investor grievances, about the CAS, the Consolidated Account Statement that you all receive, and we will end with some of the important points that are important, right? So that's how the flow of the presentation would be. So starting off, we'll see what primary markets are. As we all know, there are primary markets and there are secondary markets. So in primary markets, as we're going to get into active form of investing, it's very important for us to know what are the types of issues that are there in the market. Generally, everything is known as an IPO, which is an initial public offering. So it is all colloquially termed as initial public offering. However, there are different terms and different meanings to it. So let's get into understanding what are the types of issues. So the first is a public issue. So what do we mean by a public issue? Any offer of shares given to the public, which is more than 50 by a single company, is known as a public issue. Then there are other issues called as rights issues. Here, there is a listed company that issues fresh shares to its existing shareholders. That's called the fresh issue, rights issue. And the other one is preferential issue. So here in preferential issue, what happens is there's a listed company that issues fresh securities to a select group of people. This is called as the preferential shareholders. So they are called as preferential issues. Then we also have bonus issues. So here the company issues new shares to its existing shareholders, and there's no money which is involved, right? So there are different forms. These are primarily four different types of issues. Now, if you see within these primarily four forms of issues, in the public issue, we have something called as IPO. So as you see that everything is denoted as IPO colloquially. However, there are different meanings to it, which we are covering right now. So any unlisted company who issues shares to the public for the first time is called an initial public offering. Means because it is initial, the first time that they're offering the shares in the market. So this is called an IPO. Then there is something called as FPO. So FPO is called as further public offering. So a company which has already issued shares to the public for the first time is called an IPO. And the same company then goes ahead and issues subsequent shares to the public. Then they are called as FPOs, which is further public offering. Now there are two types of issues there as well. One is a fresh issue. A fresh issue means a listed company is issuing new securities to the public. And the other one is an unlisted company which is issuing the existing shares to the public. That existing shares could be held by some of the promoters, or could be held some of by the internal people. So once that is issued to the public, then they are actually called as OFS. So these are shares which are already issued, but now is being issued to the public for the first time. So we have fresh issue, and we also have the OFS. So if you see the primary market, there are different types of issues in the market. Let us henceforth now start understanding more into whether it's a fresh issue or an OFS or is an FPO or not, right? So now we saw that different forms of issues are there. So once we've seen the different types of issues that are there in the market, we would like to go ahead and invest, right? However, you'd be very careful to understand that whatever investments we are doing in the market, generally, either there's a gray market or there's a hype being created by some companies, and we go ahead and invest without doing proper due diligence. So whenever we are investing, and this is an active form of investment, let us not go by the news that are floating around in the market, or just by some promotions that have been done, or the gray market news, whatever is there, right? So we need to do our due diligence. So what is due diligence? So due diligence basically is a very systematic process of analyzing and investing all the material, non-material information before you actually go ahead and invest in any particular company. That is what due diligence means. Now, when we talk about due diligence, what are the things that needs to be analyzed? There are definitely a host of factors that are there, but we noted some of the important factors which are very important for us to note down before we go ahead and invest. It could be the company's financial statements. It could be the competitors who are there in the market of the particular company or the product that the company manufactures or is in. Then is the performance of the sector. Then you have the company management who is there, the company's corporate governance records, the brand value, the perception of the people regarding the particular company, the satisfaction level of their customers, and also the retention level which the company is able to maintain. That is the repeat orders which they are getting. So if you see, there are a host of factors that are involved. So there are a lot of information that needs to be, whatever is mentioned on the screen is at least bare minimum which we should think about before proceeding. So there are a host of factors. Since there are a host of other factors, we need to understand first what is due diligence, and then we will see how to go about and start analyzing this thing. So in case we are not doing our due diligence, then what happens? If we are not doing our due diligence, it simply means that we are driving a car on a highway blindfolded. We would never do that, will we? So investing in any company without doing our due diligence translates to driving on the highway blindfolded, which we should avoid. So why is due diligence required? What is it? So it's a proactive approach enabling investors to investigate about the potential and the prospects of the investment in any company. It is to better understand the past performance, and it also gives you a greater possibility of the future growth of the investments. So these are all enabling factors that helps you how you can do a good due diligence to start investing in any company. So what are the sources? Definitely, these days, there's a lot of social media news. Yes, it is one of the factors which needs to be taken into consideration. But please understand, all of these factors has to come out from a well-researched material. It's not some tips what are following in the social media that we need to follow. So definitely, stock exchange is one of the places where you can go ahead and find out all the information. The company's website is another source. Then we have research reports that are there, and also social media. But the point 4 that we have mentioned over here, social media, I would request all of you all to please be very careful when we are seeing news on the social media. Hence, there is a lot of misinformation today available on social media rather than authentic information. So I suggest you be very careful when you are following the news and referring sources that are in social media. So if you see how to do an analysis, there are 2 ways you can do it. So I would obviously recommend a multi-layered analysis rather than just a particular view that is being taken. So multi-layered analysis can be done. It's either a top-down approach or a bottom-up approach. So what happens is, in one of the approaches, you first analyze the economic factors, then come down to industry, and then come down to company. Or the other way of doing it, if some company piques your interest, so you can go bottom-up approach, where you can first talk about see the company, then analyze the industry, and then analyze the economic factors that impact the industry and take a call. So it's a different, both are different. Both of them are correct in their own sense, as long as we are covering most of the factors. So if you see in practical experience, you will have definitely both ways in which you can do your analysis. So we see, as we discussed, there are a host of factors which need to be taken into consideration. So if I talk about the company and the industry analysis, so these are some of the factors which we should definitely take into consideration. Where first we need to check the data, which is related to the macro and microeconomic factors impacting the stock, the industry, the stock price, how it is impacting. That is one. Then we need to understand what is the business model, which industry it is functioning, what is this, whether the business model is sustainable or not, what is its growth prospects. That's another part we need to take into consideration. And then take into account the past track record. Obviously, the past track record will not always predict the future, but definitely it is some way of seeing how the company has performed in the past, its turnover, its profitability. It will give you an indication of the future as well. Then there's a corporate track record which needs to be taken into consideration. The reputation of the promoters who are involved, their shareholding, as to how much shareholding, how much skin in the game do they have. Those are some of the factors that needs to be taken into consideration. And you have the company's financial health, examining the financials of the company, the cash flow statements, the income statements, the balance sheet, the past 2 years, other details records of the company, the EPS ratio, PE ratio. So these are the indicators of what is the financial health of the particular company that we are intending to invest in. Then there's a total debt of the company, the net worth. Then comparing what the competitors are doing, the price volume data, the historical data, the corporate announcements of this particular company. So as you saw, these are some of the factors that you need to take into consideration. So we'll not discuss the entire gamut, but even giving you a small clue as to what of the things it entails, so that you can which helps you to do your due diligence before you invest in a particular company, right? As is famously said that if you are willing to invest in a particular company for the next coming 10 years, only then you go hold it. Else, please do not buy it even for 10 minutes, right? So if you're willing to invest in the company for the next 10 years, then please hold it. Else, don't even buy it for 10 minutes, right? So whatever factors we discussed over here, so there's a combination of a quantitative as well as qualitative analysis that we have, you'll have to do before you invest in a particular company. So I just imagine that we have done certain basics and we want to invest in a particular company. So when we invest earlier, what used to happen was that, we used to fill up the form and also write a check and give it to the broker, the company, and the company used to encash the particular check. So once it is encashed, in case if the shares are issued to you, well and good, the shares will come to you. And in case the allotment doesn't happen of shares to you, and then you used to get the refund. So obviously there's always this problem of whether the refund will come on time or not, whether the refund was coming at all or not in the first place. So those challenges were there. So what has happened was an ASBA mechanism was introduced. So ASBA is now mandatory, which basically means this application supported by a blocked amount. So what happens is that the amount stays in your savings account, and only a block is created upon that. After you submit the application, the block will be created in the bank account and the amount will stay in your own account. And in case the allotment happens to you, then the money is debited from your account. And if the allotment of shares does not happen to you, then the block is released. So you would be free to use that money. So what is the advantage? There are two advantages over here. One clearly says that if you use the ASBA facility, you continue to gain interest, on the savings account. The other advantage is that in case the shares are not allotted, you did not get any allotment, then you don't have to run around for the refund. Only the block will be released and it will stay in your own account. So you are not running around everywhere with your grievance for the fund not being refunded to you, right? So this is through ASBA facility in IPO. So we saw something around that, what to do with the, in a scenario when it's an IPO. So now we'll come to a scenario where we talk about a secondary market. So imagine I want to buy a particular share which is already trading in the market. So I've moved from primary markets. Now I'm coming to secondary markets. So in secondary markets, we'll talk about, what mechanism takes place. So these are some of the basics, no matter what you buy or what you sell. So we'll talk about each of the trades separately. What happens when it's a buy trade is executed. We'll also talk about what happens when a sell trade is executed. And we'll talk in terms of funds as well as in terms of securities, right? So first we'll talk about some buy trade. So you have executed a buy trade on the trading platform through your stockbroker. So either you have done it, you have spoken over the phone to a stockbroker to place an order for you, or it could be an online mechanism where you would use a mobile app to place a buy order. So once you place the buy order, what are you supposed to first check? So in terms of first, we talk about funds. So assuming that you want to buy some particular securities, so it comes under cash market segment. So before you buy a particular securities, you need to have minimum upfront margin in your account for any trade to be executed, right? So it could be right even as low as 20%, which is minimum, right up to some scripts could also have 100% margin, which means you're supposed to have the entire amount in your own account before placing the order, right? Only then the order will be accepted. So you have to pay that upfront margin first, which comes between 20 to 100%. And then the balance of the money you need to pay before T+1. But why T+1? As you know, settlements in India now happen on T+1 basis because one of the fastest, settlement timelines that we have seen. So T+1 is when the settlement happens. So when we talk about settlements, basically, what does it mean? Settlement means the funds will move from the stockbroker to the exchange or vice versa, right? And also securities will move from the stockbroker to the exchange or from the exchange to the stockbroker. So that is what we call as settlement, right? So what happens over here? Balance you have to pay before T+1. Why before T+1? Because T+1 is when the maximum time that the broker has to pay the money from your account to the exchange's account. So exchange has to first receive before T+1 the entire money. So before you place any order, you'll have to pay the upfront margin, and the balance, whatever needs to be paid before T+1. So that could be also after the trade is executed, but before T+1. And by T+1, then the broker will have to transfer that same fund to the exchange. Hence, it needs to have the funds paid by you before T+1 in order for them to transfer those funds from your account to the exchange's account, right? And then what happens about securities? So as you know, settlement happens in T+1. So these days, the actual rule says that the moment you buy a particular script by T+1, T, what do you mean by T? T means the trade day, the day on which the trade is executed. So assuming the T day is Monday and T+1 will be Tuesday, which is T+1. So one is mentioned over here is obviously the trading day, working day. So T+1. So if you place any trade on Monday, on Tuesday, the broker will receive the securities from the exchange, and within 24 hours, the securities will transfer from the broker's account to your demat account. So T+1 plus 24. So T+1 is settlement where the stock exchange will transfer the securities to the broker's account, and then in turn, broker will transfer within 24 hours. But these days, since everything is technology driven, so on the day end by T+1 itself, most of the shares will come into your account. You don't have to wait for the next day. So now, assuming that I'm going to do a sell trade. So in a sell trade, first comes in the pain of securities. So selling something, that means you own the securities. So first, your investors advised to first check whether the shares are available before executing that particular trade. So after you have checked, you have to transfer it on the T day itself to the stockbroker, because stockbroker then needs to enter, transfer it before by T+1 to the exchange. Same concept. And so all those who have not signed the DDPI, which is a demat debit and pledge instruction, or the POA, they will have to ensure to sign the DIS slip either physically or through EDIS. So I'll come to the concepts of DDPI slightly later on. It's a new mechanism through which investors are advised to choose rather than the POA option, right? And then regarding sell trade, the payout of securities. So since the cash segment, T+1 is when the settlement will happen, and within 24 hours, the funds will come to your bank account, right? So this is how the settlement mechanism works in secondary markets. And one thing, cash dealing is strictly prohibited. The only transfer will happen either through check or RTGS and NEFT or any electronic mediums are only allowed, right? Cash is absolutely strictly prohibited. So this graph could be seeming complex. However, I'll just guide you through it. It will not be difficult. So this is how the mechanism actually works. So when a person places an order, say he places the order to buy 10 shares of ABC Limited, that is placed to the broker 1, which is in blue on top. Then the broker then hence places that order to the exchange. Then the exchange has an order matching engine, which does the matching of the buyers and sellers order, right? Both the orders are matched, and then it goes through a clearing process. So first trades are netted off. What do you mean by netted off? If you're buying, say, security ABC, right? You're buying, sell, and selling 10. So they will be netted off against each other. So there will be no obligation for funds, securities. However, there may be obligation for funds. So netting of trades is done, where a buy is also netted off against a sell, right? And the final obligation file is there. So once the final obligation file is there, and then this payout then goes to the broker. From broker, it goes to the client, right? And meanwhile, as we discussed, before T+1, while the order matching mechanism and things are taking place at the exchange, you will also have to pay in the funds to the broker. That's when the clearing settlement process will take place, right? So same way the way we discussed for buy, same will happen for a sell order, right? So this is just to just check the understanding whether we have it right or not. So the important point which we like to drive through is that which of the following is not advisable while investing in securities market. It says that first, always deal in cash. Obviously, we discussed that cash is not prohibited. The cash is prohibited. Hence, this is not allowed. However, the other things are mandatory, which is consult a SEBI registered investment advisor in case you have doubts, and you want to understand about your investments. So one is you can do the research on your own. The other way is dealing and asking a SEBI registered investment advisor who will study your entire details. What are your obligations? What are your goals? And as per your risk appetite, they will suggest you a plan of action. So that could be either executed by you or by them. That will depend on the agreement you get into it. So please deal only with the registered investment advisor and not with anyone else. And so we spoke about social media some time back. So there, whatever advice, whatever tips you have been getting, all that, please understand, does not come from a SEBI registered investment advisor. So they're not liable to answer in case anything is a problem. So deal only with the registered ones, right? And keep record of all the documents signed, obviously, which we will, and keep a regular check of your running account, right? So the part one is we are not dealing with cash, and other things are advisable for us. So if you see a lot of SMSs and WhatsApp, emails, social media, it will be flooded that they will give you either a fixed return or a guaranteed return. So the question here arises, how much is the minimum guaranteed return or a minimum fixed return in securities market? The options given to us are here that only the capital is protected and the returns are not protected. Returns are variable, right? That is one option which is given to us. The other one, it says that there's a minimum guarantee that will give you, that minimum guarantee has to be agreed between you and XYZ, that so much returns you can get. The third one is that you will definitely get an average return of 12 to 18%, which is guaranteed. the other option that is given to us, that returns are subject to market risk and there is no guarantee or fixed return in securities market. Obviously, the answer is the last one. There is risk involved in the market. Hence, because of the risk we are taking, the returns that you get than the traditional instruments are higher. Hence, the risk we are taking. So, your answer will be the returns in the returns are subject to market risk and there is no guarantee or fixed return. So, all the advertisements that you have seen here and there, some of them are too good to be true. In case your intuition tells us it's too good to be true, believe me, yes, it is too good to be true, right? So there are no minimum guarantee. There is definitely market risks, and definitely there are different ways in which we can, understand what the risks are. There are ways in which we can minimize the risk. There are ways in which you can manage the risk. So please understand the words. We can understand them. We can manage it. We can, reduce it by diversification. But obviously, you cannot eliminate risk. If you eliminate risk, then it becomes your fixed return, which is not allowed, obviously. So, just taking you through one particular case study, you may get something like this. We have seen a lot of examples in the market. Request you to, please not fall prey to these kind of messages. It could be through WhatsApp. It could be through Telegram. We started with a lot of SMSs and calls. Obviously, social media has taken over, and there are a lot of social media Telegram channels and WhatsApp messages that you will receive. It could go something like this: that you invest minimum 1 lakh with us, get guaranteed 8 to 10% monthly returns. So we translate that to 12. You know what the numbers are, right? And it will say that you need not understand the dynamics of the trade. There is no requirement for you to trade. We shall trade on your behalf. The more you invest, the more it will give you. Last chance, you are a lucky customer. So you see, these words will be used to try to lure people into investing into schemes like this. So what do? Guaranteed returns, is it a myth or a reality? As we discussed, it's a myth. And one can trade based on tips. As we already discussed, that also is a myth and not a reality, right? So hopefully we'll all stay away from those kind of tips. This is again reiterating the same point. There are a lot of unsolicited stock tips that come into the market through various channels. And in case you come across anything, there is a reporting section on our website. Please not only not invest in that, but also report the same thing to the exchange so that we can take steps required, right? So let's go through one more understanding. On what basis do you make investment decisions? As we've been talking so long, what the things that we should not obviously do. Trusted advisors advice. Mere friend ke advisor, my friend's advisor has advised this. So please understand, he might have advised that for his risk appetite, for his goals. So goals for you and me are different. So this is not a perfect science where one formula will fit for everyone, right? Just because somebody advised someone to do something, that does not mean we follow the same advice, right? A lot of hot investment tips we should not go through. This is very common. A lot of my favorite, investment program on TV. And there will be a lot of advice being given to you. So please understand, those are advice for very generic advice may not be suited for you. You need to understand whether that advice given to you, whether it suits your profile or not, right? Then as neighbors and friends do, believe me, by the time the news is in the market, there are a lot of professionals in the market who are there. By the time you even log into your trading account, it will already be discounted in the price. So people are that fast. So, rather than, hearing any news, just because somebody got some order from a news channel, I heard it, go into investment and buying only basis of that one particular information may not be the right way forward. Then do your own research. Obviously, that's the answer that will be to this question. They do your own research. Returns assured by some brokers. Please do not go by that. If there is a research behind it, obviously go to that research. There'll be a lot of assumptions made in that research. If it suits you, then you please go ahead and invest in that particular stock. If it's basis on some research, basis on some study, basis of some assumptions that you also agree to, then you would go ahead and invest. Then others who have invested from that particular investment decision, Manoj ne invest kiya tha, Manoj has invested in a particular stock and gained returns. So that is not an indication that in the future also it will earn similar amount of returns. So these are a lot of scenarios that you will come across in your real day-to-day life, which I request you to please stay away from. So as we discussed, the reiteration, the sources of intelligence have to be the stock exchange website, the company website, the industry research, the magazines and newspapers, and social media, but very, very carefully. So you see, there's a lot of products which are unregulated and platforms which are unregulated. So request you to stay away from them. Why do we do that? Because if it's a regulated platform, in case you have a grievance, then you will definitely have somebody to hear that grievance, somebody to listen to you. You'll have some protection mechanisms that can protect you in case of frauds and things like that, right? So there are different protection mechanisms in place for you. If it's a regulated platform, if it's a regulated product, but if it's unregulated, these benefits will not be available. So stay away from this. It could be like, some people, unauthorized, unregulated platforms giving you algo trading, automated trading, binary options. See, they're a very fancy way of marketing them. So it is very easy for people to get lured into something like that. So a lot of them will tell you that, we have used the strategies when we have back tested the strategies with the different market scenarios, it has given us stupendous returns. And the rating to this is A triple plus. So they're back testing the strategies. Believe me, that's not the only way to move forward. It could be one of the parameters for you to measure, but not the only ones. So these are all unregulated. And it will be reference about some past performance that we have got so much of return in the past. And could be also expected returns out of the algo trading. So in this, please understand, they're not covered, so you will not get any protection mechanisms. So please stay away from them. And assuming that you are, in a particular regulated environment, you are trading in a regulated product, and in case you still have a dispute, obviously approach your stockbrokers. They are very definitely approachable. You can find the email ID and the phone number on their websites, and also on the contract note that comes to you. So moment it comes to you, definitely you can go ahead and seek clarification from them. I'm sure you will get your answers and clarification. In case you do not get any clarification, you can obviously approach the stock exchange on which the trade was executed, or you can also approach SEBI, right? So when you're corresponding with the stockbroker, understand that, complain it to them in writing, retain certain copies and the ticket numbers which they give you. And in case it's not addressed, then you can reach out to the exchange or SEBI. So if you reach out to the exchange, in case any matters that are not getting resolved with the stockbroker, then there are processes and fields through which it will go through. One is an investor services cell, wherein 15 days are there with the exchange to try and resolve the grievances between you and the stockbroker. And in case 15 days are not enough and it does not get resolved, then it's another mechanism called as an IGRC, which is an Investor Grievance Redressal Committee. So it's a grievance member. It's an external third-party panel member that will hear both the sides and pass an order. Post which it will, in case anybody is not satisfied, it will move to arbitration, which is a quasi-judicial mechanism. And after a quasi-judicial mechanism, it is an appeal mechanism, and then it moves to the courts. That's how it will progress in case any one of the parties are dissatisfied with the order being passed. And as I told you, there are different ways in which you can raise a grievance. One is going through the exchange portal. We have an online portal in which you can file your complaint. SEBI also will take up the complaints. There's a scores portal, which is SCORES, which translates to scores, which is SEBI complaint redressal system. Then you can also shoot an email to SEBI or the exchanges. You can also write a physical letter in one of the investor centers that we have, or you can also visit the center and take a complaint form physically and fill it out, right? So in case you decide to go through the scores platform, so there's small steps that you need to follow. It's very easy for us. In case you visit the platform, which is scores.gov.in, which is scores.gov.in, scores.gov.in, and you visit the platform, you register yourself, select the complaint, what the category is about, fill in the details, add the documents which are there and submit it. It's a very seamless process that you can go through. One thing what I would like to add over here is that in case you have any doubts, in case you have any before your investments, there are some toll-free numbers that are available on which you can call them, which is 1-800-266-7575. Is 1-800-266-7575, right? So you can raise your grievance over there. You can also go ahead and if you have any doubts about some investments, about some registration numbers, you can approach them on these phone numbers and get it clarified, right? So one information that is for you all, there is a cash statement. So it's an initiative wherein we try to consolidate all the financial assets that you provide, that you have, and will give you an insight into your entire portfolio across different asset classes. So it will include all your equity shares, your mutual funds, your preference shares, your sovereign gold bonds, your debentures. So all the financial assets that you have, it will give an insight and create a portfolio. So it will basically be a bird's eye view into your entire investments, right? So as we discussed all along, there are certain things that, whether you've started investing, whether you are investing, or you plan to invest in the future, there are certain things which are very important for us to keep in mind. And I'll just go through the important alerts that are very important for you. It'll be a reiteration of a lot of what we have discussed, but it's the highlights for you to take home. One is there is no cash dealings and there is no assured returns in the market. So the KYC form that is given to you, please read them carefully. Do not sign anything blank. And in case something doesn't pertain to you, ensure that you strike off the particular page or write not applicable for you and not leave it blank, right? Then it is also advisable to deal only with registered intermediaries and do not share your password, no matter who the person is or what he asks you. As you would have heard in a lot of conversations that, people will not ask you for your password. That is true. Nobody will ask you for your password, be it brokers officials, be it bank officials, be it in stock exchange officials. Nobody will ask you for your password. So do not share your password at any circumstances with anyone. That's your own password, right? And the other thing is a lot of people do sign the running account authorization, which means if you see the entire KYC form, it has voluntary documents and a lot of non-mandatory documents. So mandatory and voluntary. So mandatory are the ones that you need to sign, and voluntary are the ones that you can choose to sign as per your convenience, right? So running account of securities is no longer allowed. So after settlement, the securities will be transferred to your demat account within 24 hours. That is mandatory. However, when it comes to funds, you have an option for maintaining in running account, which means whatever funds are coming out, the broker can maintain it on your behalf. And in case any payment needs to be made, it will be made from that particular funds that is kept aside. But please understand that if you are a regular trader, then obviously it makes some sense to keep additional funds in case an opportunity arises for trade. However, in case you are not trading regularly, I would always advise that do not keep your funds idle. It's not that you're going to earn any interest, right? So in case you're not trading regularly, transfer the funds back to your own bank account so that it's safe with you and you can start earning interest on that rather than keeping it with the idle with the broker, right? And avoid any herd mentality. Just because somebody's investing somewhere, just because everybody's investing somewhere, you also need to invest. Please don't have that mentality. So invest in businesses that you understand and not because everybody's investing. As you all know, the great Warren Buffett himself, never invested with IT companies and, invested with more traditional forms of businesses because that's what he understood it, right? So do not try to time the market. Let us have a very systematic behavior of the way we are investing. So as we heard the SIP term, right? We heard SIP. So basically SIP is one of the passive forms of investment where you are doing a systematic investment planning. It's a behavior rather than trying to time the market. So let's get into a systematic behavior rather than trying to time the markets. Same way for stocks. If it's a good quality stock, you can buy it. The best time to buy was yesterday. The second best time to buy is today. So don't wait that, once a stock price crashes or it comes down, then you'll go ahead and buy. It's very difficult. You cannot time the market, right? then do not invest based on stock tips or unauthenticated sources, and do not fall for that fraudster sending promising emails, SMSs, and other things. The exchanges and as well as the stockbrokers, as well as the depository participants, all of yours will give you a lot of information on your trading, on the transactions that happen. So ensure that your mobile number is updated so that the right information reaches you at the right time. And in case you're not executed any trade, but by mistake something has been executed in your account, you receive the information immediately for you to take a prompt action. So regularly log into your account and check the balances that are there. Opt for a contract note in electronic format only if you know how to do it, and check regularly, check your emails. Else do not opt for that and go for a traditional form of post to your home. And whenever you open the account opening form, ensure that you understand all the brokerages, commissions, fees that is required. Apart from brokerage, there are a host of other charges that are there. So you please ensure that you understand them before executing the trade. And any trading that you're doing has to happen through banking channels only. So assume this is a small capsule of whatever we had in store for all of y'all. We try to cover certain basics of primary markets, secondary markets, your protection mechanisms that are there. So in case you like to learn more about these kind of security markets, that you can go to SEBI's website. I hope on the screen you can see the URL. So they also have an app called the Sarthi app. So either you can refer to the Sarthi app or you can refer to their website. And also a lot of content will be available on Exchange's website as well. You can go through these host of websites to check for and learn about more information that you want. And as you saw that, this was a particular program targeted towards a specific audience set. So in case you want to learn something more about, passive forms of investing, more about financial investing, or you want to learn more about advanced concepts of in investing, and, about your psychological behavior and all of those things, then we have other programs that are there. Definitely, you can go to our website, nseindia.com, and you have a section called Invest, under which you'll be able to see Investor Awareness Programs. So we have a host of programs scheduled throughout the country. A lot of them are having through webinars. So you can choose, your timing whenever you're comfortable to log on to these particular platforms and go through it. It will not require registrations also, and it's all free of cost. So you can go through and attend any program at your own convenience and leisure, right? So with this, I'll complete my today's presentation. So the theme is Soch Kar, Samajh Kar, Invest Kar. Thank you.
Thank you so much, Gaurav, for a very insightful session. I am sure the viewers and the listeners will definitely walk away with a lot of information that will help them to make a more informed decision. And without any further delay, as I mentioned earlier, we will open the floor for a question and answer session where Gaurav will be taking your questions. But before we start that particular session, I would definitely like to remind you that this session is going to be where we will talk about, different questions, and Gaurav will be answering them, but there will not be any answers given on the basis of recommendation, because that is something that we do not do. So without any further delay, Gaurav, over to you again. I'm sure you'll have lots of questions piling up.
Yeah, I'm waiting for some questions to be put on the admin panel.
All right.
So let us give our audience about a minute or so.
Yes, of course. while the questions are being pinned to the admin team, I would like to thank the entire team who is behind this webinar for making it a success. And also thank you to the audience for joining us here today. We do have many webinars lined up, so keep an eye for that. I'm sure that it's going to be helpful for you in the long run and will help to answer a lot of questions that you have regarding your investments.
So Amrita, a lot of questions that are pouring in right now,
Right.
more to do with the kind of recommendations that are there.
Which we do not encourage.
Right. How is August looking like? What are the IPOs to buy? Which futures to buy? Losses in the account. So I'll do one thing, and I'm not going to take which recommendations. Obviously, who would not be the best people to guide on the recommendations part of it. Your investment advisor would be the best person to go to. What I would rather do over here is that, as we discussed that, first there are passive forms of investing and then there are active forms of investing. So in active forms of investing, it is always very good. We've seen a lot of people that, they directly jump into buying options, jump into buying futures and forwards without, understanding the nuances are there in the markets. So please understand, as per the risks that are there, obviously, in options and futures, there's a lot more risk is involved. It is a highly leveraged product. So as you discussed the entire presentation, if you have seen that we've not discussed too much on futures and options. So what we would like to do is, for people to start investing in the markets by doing active forms of investing, understand what is there, get yourself involved in the capital formation of the country, see how it you contribute to the betterment of the capital and society by investing in cash markets, understand what it entails, and then move towards going into futures and options. Because cash market, what happens is, in cash market, it's a all win game. So if the stock price goes up, you all win. So it's not a zero sum game. Whereas the futures and options are like a zero sum game. One obviously wins, the other loses. So it's called a zero sum game. Whereas when you talk about cash markets, it is definitely more to do with all of us gaining, and in turn the growth of the economy. Why this basically the idle capital which is there, it comes into the markets for the growth of the country. So that's how we need to concentrate on. So investing in futures and options takes a lot and lots of high risk. You need to have high risk appetite. You need to have the knowledge. You need to have the expertise and a lot of patience, right? So it requires a lot of skill sets which you can develop over time. So please request not everyone to jump into trading in options and futures. First, get into passive forms of investment, then active forms of investment in cash markets. Understand how the markets function, and then move forward to futures and options, right? So one question that I have over here is, can two people have joint demat account? Yes, definitely they can have a joint demat account. And it also talks about its tax, tax implications. Please understand, you can have a joint demat account, but you cannot have a joint trading account. Trading account has to be a single person, and it can be a joint demat account. So obviously taxation will happen in terms of the person who has bought the account, bought or sold in his trading account. Right? And trading account is always single and not joint. Only a demat account can be joint. One question we have over here is that, is the recording available? Can we answer that?
Yes, I believe that we do have the recording available. I think we will be putting up the video in our social media. So keep an eye for the space.
Okay, so one more question that I have here is that, how can a promoter's credentials be verified for an IPO? Whenever IPO is released, you have a huge documentation that is there, right? So all this, if you go to our website also, the entire details of the entire history of the company which they have submitted to us through red herring prospectus will be available to you. So it will entail a lot of information regarding the company, its promoters, its background. All of those details will be available. So it will definitely be a lengthy document, because there are a host of factors that they have to come up and declare, which is very important for us to understand and before we go ahead and invest, right? So you can please refer to that. Okay, so while the questions pour in, I have a couple of things that, there are a lot of frequently asked questions that we get during these sessions. While the questions pump in, I'll add a few, questions that keep coming to us very regularly, right? So one of the questions is that, what is a market depth? That's something that, you keep hearing that about in the, news and people talking about. So basically the market depth is a simple meaning where, it's the total value of all the securities traded in a given day. So that's how we compute the depth of the market. And the other thing what comes up is that, like we have Samriddhi over here. So in terms of anybody who's Samriddhi over here, they are advanced, they are adverse, is well, adverse with securities market with a high risk appetite. What should be the ideal form of investing for him? So as we already discussed this particular point as well, that if you're already investing in stock markets, the cash market very well, how it functions, only then it's advisable for us to move to the futures and options segment. Till then, I would suggest you to refrain from investing in them because they're highly leveraged products. So even if the profits come up, it will be substantial. If you lose money, also is a substantial amount of money. So here is when you not only lose the interest portion, but also your capital. You tend to lose the capital as well, right? Because of it being a very highly leveraged product. So I'll just take you to one of the one or two things that you always get. That once you buy a particular securities, there are a host of documents that come to you. So I'll just take you through the kind of documents that are required over here. One is that you receive a contract note, which is the confirmation that the trade will get executed in your account, right? And it's a confirmation of what security was bought, what was the price at which it was bought, when was it placed, the time that it was placed. The other thing that will come to you is the ledger statement, or the statement of account of funds, which we call. That's the transaction of all the funds that you gave to the broker and received from the broker. The other one is your demat account, which is also meaning that it is the account of the securities that came to your account and went out of your account. That's another document that will come to you. Then these days you will get at the end of the day, you will get a day end email and an SMS from the broker as well as from the exchange. Then you get a weekly balance. What is at the end of the week, what is the balance available of funds and securities with the broker? You'll get it from the stock exchange. A lot of brokers also do provide that particular statement. So whenever you receive these statements, what are you supposed to be doing it? Please go through statements and check, is there any order that you have not placed? Is there any the price point as which you have executed? If you have any dispute regarding that, go through the statement and see that if they tally, right? You will have to keep a regular check of those particular accounts that are there. So the host of statements that will come to you, and please check them regularly and whether they're tallying with whatever you have, records that you have. And in case of any issues, you can take it up with the stockbroker, right? So I'll take up one or two more questions before we wrap this. So as we saw during one of the questions that has come on the panel is our panel is that somebody has chosen for running account of funds, and they're saying when the running account of funds needs to be settled. So that's the question that has come. So please understand, when you have an account opening form, the running account of funds that are there, whatever you are seeing, so there will be two options for you. So in case you are not trading regularly, you're supposed to be it's advisable not to sign for a running account and have the funds transferred back to your bank account. In case you are trading regularly, then please ensure that you will have an option given there, a monthly or a quarterly. So you can choose whether you want the funds to be settled on a monthly basis or on a quarterly basis. So no matter what you choose, the day is fixed. It will always happen on the first Friday of the month in which you choose, if it's a monthly settlement, or the first Friday of the quarter that you're choosing. So the first Friday is fixed. If you're choosing monthly, it will be a first Friday of the month. If you are choosing quarterly, it will be a first Friday of the quarter. So another question that has popped up is that what is DDPI? We were trying to explain what is DDPI, which basically means demat, debit, and pledge instruction. So as you see, initially we had a power of attorney. So in power of attorney, there were lots of powers that you could give to the stockbroker. These days, we have a new concept called as DDPI, where it is only limited number of powers that you can give in that particular DDPI mechanism to the broker. So it can be only 3 of these. One is, so any security that was sold by you that for delivery to the exchange, one is that. Second is for margin obligation, so you can pledge it. So pledging will happen through DDPI. And the third is in case of any mutual fund transactions or tendering shares in the open offer, then you can use DDPI. So DDPI will be used for these 3 mechanisms. So one very interesting question that has come up is, what is an ETF and what form of investment is this? So basically, ETF basically means it's an exchange traded fund. It's a very passive form of investing. So basically, if you look at a share, there's a disadvantage of buying a particular share, which means it is not diversified. And if you get into portfolio mutual funds are definitely they are diversified, but they cannot be bought and sold like a share. So you cannot do an intraday, for example, in case you are wanting to do it. So you can best get into ETFs. ETFs are a passive form of investment where it is basically like a mutual fund, which can be traded like a share. So it's a very interesting form of investment to move forward in case somebody wants to do in a passive form of investing. Okay, so one question that has come up is where to invest at present levels. So this is a very generic question. I'll try to answer as best as I can. So I'll this and one more, we'll take it a wrap then. So where to present? So please, I don't know what your age is, but definitely, as they say, the younger you are, the more ability to take risks. Why do they say that? Because in case you end up losing any funds, you will have more amount of time up your hands to get the money back, right? So younger you are, you can definitely go into more riskier forms of investment. And the older you are, closer to retirement, I would advise to not get into very risky forms of investment. Having said that, you would not put all your money in one particular asset class. Obviously, it has to be diversified. So you can every single product that you see in the market has risk associated with it. So they come under low risk, which are your public provident funds, your PPFs, your PF, all that post office savings account, all that comes under low risk. Then you have medium risk. You have medium risk, which basically means your mutual funds, which are hybrid type of mutual funds, gold, your real estate, all of it comes under medium risk. And then you have high risk, which is your futures and options, all of that come under high risk. So when you are investing, so it is not one asset class that you will invest in. You'll obviously invest in different asset classes. So in case you are young, you can put probably 70-80% of your money in riskier instruments. And in case you are closer to retirement, the same will be only probably 10-20% of your investment in risky asset classes, right? So that will be a guidance factor for you as per your age. Hope that helps you take some decisions on investing. And in case you have any more doubts in it, we definitely have registered investment advisors who will read your entire portfolio, see your goals, what are there, and give you authentic advice, right? So how many stocks should be there in a portfolio for diversification? As I told you, diversification wouldn't be in terms of only stocks. Diversification should be in terms of asset classes. That's what we answered some time back. Medium risk, low risk, and high risk. So the different asset classes, we call them. So all the assets like your PF and anything with bank is different asset class. Your gold is an asset class. and your futures and options and investing in equity markets are different asset classes. So it is not number of stocks that you must have in your portfolio for diversification, but diversification has to have over different asset classes, right? And somebody's asked, how do I, where can I view the session later? Okay, thanks. Thank you. At least maybe somebody's definitely has liked the session and wants to know more about it. And we said the recording will be available. And so one person has said, I have enough of debt and SGB instruments. If you have enough of SGB instruments and debt, you can obviously move into, depending on your risk and age, you can also move into different asset classes which are slightly more riskier, like equity or risky mutual funds, or high risk mutual funds, or even futures and options. But that would be the last after knowing investing in other asset classes. Right, I think this is the questions that we can take now, and we are out of time. And in case you have any more questions, you obviously can take it up with your stockbroker. And in case, we definitely have other sessions, as we told, online. So you can come to our online sessions. We have a lot of trainers with us who can answer your questions further as well. So I hope the session helps everyone right now. Back to you, Amrita.
Gaurav, I am 100% sure that the session is helpful. That is why people are looking forward to more number of sessions like this. So thank you very much for being a part of this endeavor. In fact, thank you, NSE, for actually addressing such an important topic, which is smart guidance for active investing. And I'm sure that we were equipped with a lot of smart guidance in the last 1 hour. With that, I would like to say that skill sets, patience, and a lot of knowledge and cautiousness, these are the things that you need, as I could actually write the notes while Gaurav was saying, to make a more informed decision and ensure that you have your future set. So on that note, ladies and gentlemen, we would like to take your leave today. Thank you, Gaurav, once again. Thank you, NSE. Thank you, the entire team who's working behind the screens to make this event a success. And thank you, ladies and gentlemen, for your time. We'll see you soon. Have a good weekend.